Then quality of management. You got to buy top quality management because great business run by bad guys. 1 multiplied by 0 is equal to 0. Or 0 multiplied by 1 is also equal to 0. So we need 1 multiplied by 1 is equal to 10. So you need 10x business multiplied by 10x management, that gives you 100 bagger. Okay? So you need top class management. And what do you look for in management? Integrity, competence, and growth mindset. Lot of passion. So passion, competence, and integrity. In India, because this is basically a first generation economy, you get a lot of entrepreneurs with a lot of competence and a lot of passion. But integrity is 0. And you are a minority shareholder. If I make money and I don't share with you, what will you do with that? It's as good as useless. So you need a lot of integrity. So terrific business run by competent management with highest possible integrity. Third is growth. This is the biggest differentiator. Once the company, you know which is a good company and good management. The issue is understanding of growth. Because these good companies are always valued fully, but for the expectation of growth. Because what is good is good. I mean, Hindustan Liver is very good that, I mean, you don't have to ask anybody. The issue is at what pace it is going to grow. Even Colgate in last 20 years has underperformed the market, or it is just about with the market. Because Colgate is a fantastic company, but it has grown only at 10-12%, whereas the market has grown at 17%. With 3-4% dividend, you've done it about 15-16% in last 20 years. So what is important is to understand growth of a particular company. And every company has a different course of growth, different variables of growth. In cement industry also, all the cement companies will not grow at the same pace. Some companies will grow at 10% volume, which is the industry growth rate, or something will grow at 5%, and some of them will grow at 40-50%. Markets will follow only earnings growth. Markets will follow only earnings growth. So you have to understand quality of earnings and earnings growth. Then one of the problems which comes is that you find high earnings growth companies. Now these earnings growth, if it is not supported by good quality business, they are the biggest traps for the market. And you have seen enough of them. I mean, every time in the bull run, which is the biggest danger, I think we must listen to this very carefully. Every bull market brings the, what do you call, the leader of the next market. And these leaders are nothing but they are low quality growth companies. And they grow like a paper fire. Suddenly it will grow 100 times, 200 times. Unitech was 200 crores company in 2002-03. It became 80,000 crores company by 2007. 400 times in 4 or 5 years. So when that kind of growth happens, what happens is they are not supported by the quality. They slump. And you get stuck with those kind of mirage which has happened in your portfolio. So clearly you should not be stuck with the growth trap. You should also not be stuck with a very high quality companies. Very high quality companies with very minimal growth. Now what happens is that companies are very good. I mean, there can be only one Bata, there can be only one Colgate. Boss, but where is the growth? You're already selling me at 40p. So you have priced the thing for the quality, but how will I get rewarded unless there is a growth? So that's a quality trap. You have to position the portfolio with high quality stocks with a high growth potential. And that's where the blue circle comes in. That's the QGLP. High quality, high growth. Then longevity of growth and longevity of quality. Growth for 1 year, like what we saw in the commodity companies. What happened? It went up, it slumped. So what you need? Longevity of growth, 5, 10, 15, 20 years. And understanding longevity growth and quality is almost a piece of art. So when all the 4 things come together, quality, growth, longevity, then you look at, that's the value equation. QGL is the value equation. Then you look at the price. The problem is people don't look at the QGL, they look at only price and they pronounce their judgment. We spend 99% time in QGL, price is just incidental. So, that was about SQGLP, what is the framework for finding multi-baggers or 100x, 1000x, whatever you want. So this is the process we follow is buy right, sit tight, and in buying right, it is QGLP process, and sit tight is buying and holding and not churning too much and focus with 15, 20 stocks. Because beyond that, for a fund manager, almost impossible to do any justice with the portfolio. So this is the value strategy which we started off 13 years back, and it has done about 21 times, whereas the index has done about 8.27 times. And this is after fees. So clearly, it has done very well. And the numbers speak for itself. Since inception, it's about 28.5%, which is not possible. Going forward, don't expect this kind of return. This is impossible numbers. You should not come with this. You might be blessed with even better number. But you must come with the expectation of 15%. And because your fixed income is 8%, if you make 15%, 16%, which is going to be the index return, if you come with that expectation, you will do very well. Because we cannot calibrate the return at 15%. From 2003, I am saying people for 15%, but this has been the return. So you'll get actual return. It could be plus, it could be minus, but we design the portfolio for 25% return. But you should expect only 15%. This strategy is even more staggering. There's a mid-cap strategy and TDOP, it is only 7-year-old strategy. It came right at the peak of the market, almost at 20,000 index in December 2007. It is up 4 times, whereas the market is not even double from there. We know the market is only about, from 20,000, it's about 50% up, whereas this portfolio is up almost 4 times. So outperformance here is almost 15%, 14%, whereas the outperformance in the first strategy is only about 9%. So this is a much more aggressive strategy because it's a mid-cap strategy. Now last 2 years, we started practicing the same stuff on the mutual fund platform because a lot of people are constrained to come into PMS strategy because SEBI has made it 25 lakhs as a mandatory thing. And thanks to our income tax department, a lot of people are not comfortable doing PMS. So mutual fund is a safe vehicle. It's much more tax efficient. But strategy is same. We practice it same way. It is as aggressive or as conservative. And here, this is a large cap strategy, which is done well. This is a mid cap strategy. Again, here in last 1.5 years, it is almost 2 times against 1.7 times of index. Then this is the biggest flagship fund, Focus Multi-Cap 35, largest. It has grown very rapidly. It is about 1.76 times, almost 75, 80% kind of return in last 13 months when the index is up about 30%. So the thought is that there is a lot of money to be made. People will make money. And somebody said in 1958, all the stocks, in spite of very many spectacular investment opportunities that existed 25, 50 years ago, there are probably even more such opportunities available today. This was said in 58 in America by Phil Fisher. So I think it is more true today for India than ever before. Seriously large amount of money is to be made. We need to find those companies. We need to position your portfolios around that. And with the sound process of QGLP, I think we should be able to do a reasonably good job. What we have done in last 12, 13 years, we are much more experienced. We have seen one cycle up and down. I'm sure we'll be able to face. Immediately my sense is we are facing a bull run, but I think the real challenge will be how do we get off that. But that's a bigger problem. Let the party start, and hangover problem will be after the party. So I think this is a time to participate in the party. Think about what you want to invest. Don't defer it too long in terms of trying to figure out where is the Greece, where is Dubai, where is Portugal, where is the Yellen, where is the China. See these 32-page guys and all the 6 channels. They need everyday excitement. Otherwise, their business will go closed. So they want excitement every day. If there is no event which is exciting, still they will create excitement. So they are interested in excitement. They want your viewership. So they will create, good things don't sell, only crisis sells. So you might have seen Arnav and all, they try to just create shout, and out of nothing they'll make a huge excitement in the night at 9 o'clock. Because personally he's a very cool guy. If you meet him in person, he's a very cool guy, more cooler than me. But 9 o'clock, he comes charged absolutely, So, so it is important that you come with a lot of confidence and with patience, and you select right kind of managers where you think that your investment philosophy, your thinking and the thinking of the manager matches, and do things which you understand. You don't have to be very aggressive in the market, but you need to buy high quality, you need to buy for long term and hold on. You need to bring a lot of behavioral superiority. To be a good investor itself is a huge thing, I'm telling you. To not bother too much on day-to-day things, and allow the manager to work on the portfolios. So with this, we'll close my remarks, and we'll take few questions. Thank you very much.